everyone. Thank you for coming along to a pensions webinar. I'll just get everything set up because this is going to be quite a quick session. Please could you make sure that you put your questions in the Q&A section, not the chat, just so we don't miss anything. And I'll share my screen. Let me just get the chat so I can see it. But yes, thank you for coming along and hopefully I'll make pensions interesting for you. So today it's just a really quick session on pension annual allowance, which is a really hot topic for this time of year and often catches out a lot of people. So a little bit about me. My name's 𝗪𝗔 𝗂𝘀𝗁 and I'm a Chartered Financial Advisor. I'm a Fellow of the PFS, which is just the highest qualification we can get as financial advisors. And I set up 𝗪𝗀𝗋𝗄𝗏 Wealth in 2024, but I've been in the industry, well, nearly 25 years now. But first, these sessions are always information only. There's no advice given on today's session. And also because this is just a quick 15-minute dive into pension annual allowance, depending on your situation, the rules can change. So make sure if you make any decisions based on today that you get it checked by your accountant or your financial advisor as well. So this is our team, a growing team. There are now 10 of us, but I just wanted to let you know that something I really pride myself on is that 95% of our clients have never taken advice before they come to us. So we're a really welcoming environment for people who are just dipping their toe in the water, know they need advice, but don't necessarily know where to turn in our industry. So what is the annual allowance? So the annual allowance is the amount of money that you can pay into a pension each tax year and get tax relief. And it's a potentially get tax relief. And I'm going to show you why. So the standard allowance is £60,000 per annum, and that 60,000 is made up of your contributions, the employer's contributions, believe it or not, anyone else's pension contributions if you've got some generous family members who want to pay in for you, which is actually a great way of family inheritance tax planning, but also the tax relief that the government pays in. You add all those up together, it can't be more than 60,000, otherwise you've breached the annual allowance. If you filled this year's allowance completely, so the year runs April to April, you can then go back to the last 3 tax years and use the furthest one away first. So, moving on. So the current tax year, the allowance, as I mentioned, is 60,000, and it's really easy now because also the last 3 tax years are 60,000 as well. It has changed historically, but the numbers are now in our favour as they're all the same. But it's not that simple because this is pensions, and this is why it keeps me in a job. So if I earn £50,000 a year, I could pay 60,000 into a pension, but I'm only going to get tax relief on 100% of my earnings. So in this case, £50,000. So if you're earning less than 60,000, you're probably not going to want to pay in, well, all of your earnings anyway, but you're not only going to get up to 100% of your earnings in tax relief. So let's say I earn 150,000, so I'm a high earner, and I've got 3 years left, 3 past years and the current year of allowance left, so 240,000. I'm only going to probably want to pay in 150,000 to get the maximum tax relief, and then carry forward the difference, so 90,000, into the following tax years. So you can really do some good planning about in which tax years in the future are you going to want to save some carry forward for. So it's really worthwhile thinking what your earnings going to be in this year, but also the following 3 tax years. So you can decide whether you want to go really hard with your pension contributions, say in this year, or whether you want to save some if you know you're going to get a big payout in maybe year 2 or year 3. So have a little bit of a plan because once you've done it, you can't undo it. So this is a quick reminder of how income tax works. So the first 12,500 that we earn, we pay 0% tax. This is personal allowance. If you're a non-earner or you're married to a non-earner or in a relationship with a non-earner and you want to pay into their pension, you can pay in 3,600 gross into a pension. So 300 a month, which is the gross amount, 240 would be the amount coming out of your bank account. So even non-earners can still pay into a pension. 20% tax rate goes up to just over 50,000. The 40% tax threshold goes up to 100,000. And then we get what I call the sneaky tax bracket, which is this 60% tax bracket. And a lot of people who are in it don't actually even know that they're in it. And this is for every pound you earn over 100,000, you lose 50 pence of this personal allowance. And so it creates this 60% tax bracket. And then over 125,000, the tax rate reduces down to 45%. So understanding which tax bracket you're going to fall into this tax year and in future tax years is really helpful when planning what pension contributions you want to pay in to help you get down into, say, a lower tax bracket. So let's say I was earning 80,000, I could pay in 60,000 this year into my pension, but maybe I only want to pay in 30,000 to get me as a basic rate taxpayer and then use my allowance in the following years. So take a moment to think or set aside some time in your diary, maybe an hour in the coming few weeks, about what is your annual allowance in the current year? What have you paid in the last 3 tax years? You can get this by ordering statements or logging in online and looking at the contributions tab for your workplace pension, but you'll also need to gather personal pension contributions and things like that if you're doing those personally as well. And then I would also start gathering now my earnings in the last 3 tax years so I can understand what my allowance has been in those last 3 tax years too, to work out what the allowance was, but then also start having that think about what will my earnings be next year and the following 2 as well. And then the other side of the coin is what you're allowed to pay in, but the other side of the coin is what do you need to pay in to achieve your goals. So there's loads of calculators out there online with the pension companies, that way you can put in your age, how much you've got in pensions so far and other assets, and what your contributions are, and then project forward to what could be your likely income at certain points if you retired at, say, 55, 60, 65 and so on. So I'd sit down and work that out as well, because if you're already on track and have got a reasonably big pension, maybe you don't need to be doing so much pension contributions, and maybe there are other financial priorities you want to focus on. This is what we do for clients. So I'll show you how to book one at the end, but we build these cash flow models for clients. So the top is, we plug everything in and say, what if everything grows at 4% a year, which is obviously quite cautious. What's the outcome? So in the top here, where you see this person says, what if I retire at 55, pay in between now and 55 into a pension, and I get 4% growth? You can see this person starts to get a shortfall here in red from the age of 66. So these are the levers that they can pull to achieve their retire at age 55 goal. It's either pay in £300,000 a year and get 4% growth, which for most people is unaffordable. Or you can reduce your expectation to being able to live off just shy of £60,000 a year. So that's what they'd be on track for. And maybe that's okay. Maybe that would achieve their goals anyway, so they're fine. The top one here is, rather than getting 4%, if you keep on doing what you're doing, you actually need an 8.2% return. So it's about understanding whether your attitude to risk allows you to achieve that kind of return. It would be a hard number to achieve year in, year out, obviously, but you want to look backwards to see what are the investments that you are in, what have they achieved, and you can use a website called trustnet.com to look at that as well. Or this one's helpful for people who either think they're going to inherit a lot in the future, or they're banking on selling a business. So it's keep doing what you're doing, rely on 4% return a year, but you're going to need to boost your pot by 2.5 million in order to achieve your goals. And then we've done the same with what if you retire at age 60 and get the same numbers, but rather than an 8% return in this scenario, you need a 6.4, 1.5 million, or you're already on track to spend 77,000 a year, so maybe that's okay, or you need to pay in more every year, which may or may not be affordable. But these kind of numbers that either we can give you or you can seek out for yourself by using these retirement tools are going to be really important to building your plan. Now, this is quite shocking, but close to 50% of people over 40 won't have enough saved for a comfortable retirement. So I think it's really important to understand which 50% you're in. And also look up the definition of a comfortable retirement. This is based on some research by Which. And for example, it includes a meal out a month and a European holiday a year. Maybe that isn't aligned with the standard of living you want, perhaps in early retirement. So at least if you're building one of these cash flow models, you can personalize it. So you can see this person spending more in early retirement than they are past 65. But that's an important thing to think about. Somebody's just asked me, is the lump sum savings lever a one-time amount? So just need an inheritance of that amount. So yes, so in this example, this person would need a lump sum in today's money of 2.5 million or 1.5 million to close their shortfall gap. So moving on, I'm aware that I promised 15 minutes of pensions, we're nearly there, but there's still more if you're a very, very high earner. So the annual allowance reduces down, so the £60,000 a year reduces if you're earning over 260,000. Now, some people might just think that's not me and switch off. But the other part of the coin is, do you think you'll earn that in the future? Because if so, it's really important to do serious pension planning now, because if you're going to be a very high earner in the future, that's going to really impact the amount that you can pay into a pension later on. So for every pound you earn, sorry, for every £2 you earn over the 260, your allowance is reduced by £1. So if you earn 300,000, you're £40,000 over this limit. So 40,000 divided by 2 is 20,000. So your £60,000 allowance is reduced by 20,000, which means you can actually only now pay in 40,000. And it gets a situation where you're earning 360,000 or more, you can only pay in 10,000, and then that's the minimum. Anybody, even if you were earning millions, you could still pay in 10,000 pounds a year. And please note here that I've highlighted this as adjusted income. So I'm going to give you a quick whistle-stop tour of the way you calculate adjusted income, because, as always, it's not simple. There is also something called a threshold income. And so you need to work out these two calculations. What's your adjusted income? What's your threshold income? For threshold income, it's if your earnings are £200,000 or less, in this way of calculating it. And this is the calculation that you do. We'll send these slides out afterwards, so you don't need to be scribbling this down. But the most important difference is the way they treat pension contributions. So this is the adjusted income, and this is the threshold income. And if you just looked online and Googled tapered annual allowance calculators, there'll be programs out there that you can use to fill in the gaps and help you work out your adjusted and threshold income as well. So here's some examples. So this is where the employer contribution into a pension causes the problem. So Robert has got a total income of 250,000 and his employer pays 30,000. So his total adjusted income is 280,000. This £20,000 over the 260 reduces his annual allowance by 10,000, so his annual allowance is now only 50,000. A second example is the employer contribution doesn't affect the annual allowance. So Katrina runs her own business and has income of 190, which is 10,000 salary and 180 of dividends. Her company makes £100,000 employer contribution to the SIP. So her adjusted income is 290. However, her threshold income is 190. So she's actually all right in that scenario. And then lastly, this is a bit more complicated, personal contributions fully restoring the annual allowance. So Anil earns 240,000 and has other income of 5,000. He's a member of the employer's pension scheme where he pays in 10% and the employer matches. He makes a personal single contribution during the tax year of 22.5. His adjusted income for the year is 269. So he thinks that his allowance is going to be cut to that 55,000. However, when calculating his threshold income, his own 46,500 pension contributions are deducted from his actual income of 245. So this means it fully restores it for him in this example. So you need to get these numbers right, and if in doubt, speak to an accountant or use one of those online calculators in the first instance. And we'll send you some links afterwards as well to help. So I just wanted to show how we would fit these numbers into somebody's financial plan. So if you remember, this client's really gunning for an age 55 retirement. And a lot of car clients will do that. They'll have a really big goal in mind that if they're going big for a big goal, if they fail, at least they've retired earlier than they would have if they hadn't really tried. So we're trying to get this 8.2% return a year. This client can, rather than the 260,000 they need to pay into the plan, they can only afford 45,000 in disposable income per year. So this is a true life plan as well that we've designed for somebody. This lady, she had 60,000 in cash for emergencies and she needed 110,000 to do up her home. So it meant that she'd got 29,000 excess in cash along with this £45,000 disposable that we then put into her financial plan. So this 29,000 we redirected straight into her pension, and this gave her a tax saving of 16,000. And then the 45,000 I used just nearly 3,000 for insurances. She's a single woman with not very good insurances at work, so it's really important to me that she had some good insurances in place. Her mortgage isn't due to be paid off by the time she's 55, so she needed to be overpaying just around 400 a month. So we diverted that into an annual mortgage overpayment. If you're going to commit to anything like that, you just need to make sure that there are no early repayment charges, but usually you're allowed to overpay by 10% without any penalty. And then I put £20,000 a year into her 𝗖𝗀 and general investment account, which left 17,000 that I could overpay her pension by, which gave her an additional tax saving of nearly 10,000. And this tax relief will come into her tax return for the following tax year. And what's beautiful about this, the first year is always the hardest, but then when the tax relief is paid back to you by the Inland Revenue in the following year, you can then use that to recycle back into the plan. So it makes the next year, either you can save more than you originally planned, or you've got more disposable income, more holidays, whatever is important to you. So this is this lady's half of the plan. She's trying to over contribute, and the other part is we've put her in some investments that at least in the past have done, but also give her a chance of trying to get closer to this 8%. And these were the investments that she was in already. So we need at least 40% over 5 years, just keeping the numbers round to get over this hurdle. This is an investment that she has. These were her 2 workplace pensions. When we looked at her appetite for risk, this was the investment that she could be in and that we recommended, which more than achieved her goal, at least historically. And you might think, well, are you just upping the risk and taking more risk to achieve her goal? And for some clients that would be all right, but this client is actually really interesting. So in this graph here, we've got performance versus risk. This risk, this red dot here represents this investment here. This shows it's taking a lot of risk versus A, which is the one I recommended. taking a lot of risk but not getting a lot of return. So for every ounce of risk she was taking with this investment, she wasn't being as rewarded as well as we'd have liked. So keeping the same, well, reducing the risk rating, we were actually able to get her a chance of achieving her goal. And then her workplace pensions were about on track, really, to be where she needed them to be. So we're just going to annually review them, check that they stay on track, because we really don't want them to drop below this 40% threshold over 5 years. And you can get we pay for software to do this for us, but you can get a simpler version of this on trustnet.com. So that was I feel like I've spoken really fast. There's one quick question. What insurances did I put in place for that lady? The insurances that I put in place for her were some critical illness and income protection. Because she's young, free and single, I didn't do any life cover because she already had some at work. But yeah, income protection and critical illness is what I picked for her. I'll go through the questions, the other ones, in a second, but if you just take a moment to think, what's my biggest takeaway, even if it's just this quick, well, it's now nearly 25 minutes, sorry to go over, session prompts you to do one thing, it's going to really help to improve. So make sure you commit and then put some time in your diary to action it. We're really passionate at LCH about giving out financial education so that people can improve, whether they're clients or not. So if you want to get more information, you can follow us at Miss Lolly Money on Instagram. We bring out a fortnightly newsletter as well. So there's lots of free information here and also on our YouTube to help. If you'd like us to build you one of these sessions, we release 20 slots a month. They do get booked up very, very quickly, usually within the first few days of each month. But if you have a session with Holly, Holly's a great advisor. She's very qualified and very experienced at doing these plans. It costs £350. If you'd like a session with me, it's £500. And we do say that if you do one of these sessions and you decide you want to become a client, we will deduct this fee anyway from future advice costs. Oh, and that's it. So I'll just go through the questions that were still there, but anyone who needs to run, please do. Let me see. So is it better to have one private pension and keep paying into that, or have two or more different pensions? So I think you've got to do the pros and cons of this for yourself and your existing pensions. Reasons to keep a pension. So before you move any pension to consolidate, you want to understand, are there any guarantees or benefits that I would lose by moving? And examples of that are tax-free lump sums, which is usually 25% of the pot. I've seen them as high as 80, 90. I've actually seen a 98% tax-free pot. And if we'd moved it, that tax-free protection would have been lost and reduced back down to the standard 25. But you need to get in writing from the pension providers, and it can be a real chore, but it must be written in writing. Are there any guarantees or benefits that I'd lose by moving this pension? And then for clients, where we're deciding whether to consolidate, because obviously that's going to be easy for admin, or keep pensions where they are, I want to do costs. I want to compare costs and performances versus what I could set up out there on the open market. But often I would say most clients, unless there's a good reason to keep a specific pension because of some of these weird and wonderful things inside it, by the time people retire, they do appreciate having all their pensions in one pot to make admin really, really easy. And most clients, by the time they retire, will have all on one platform, all of their assets, so that each year we can just pay out the money in the most tax efficient way, and it keeps it really simple. Somebody's asked, what was the total monthly or yearly payment? I wonder if that was to do with this section here. So these numbers here are if you have a 4% return. This is what I plugged into the model already. So if you get a 4% return, this is the additional amount that you need to save. or reduce your expenditure down to these amounts, or you need to do an 8.2 or a 6.4% return to get the desired income for the client. Next one, oh yes, TrustNet, someone's saying they're going to be using that, so that's example. Great. Oh, the insurance example you're asking, sorry. To be honest, I can't remember the monthly payments, and we do insurances, but there's a lady that I use called Naomi who does it all day, every day. And I have to say, because she does that all day, every day, we tend to refer out to her. So if you want some insurance help, we're very happy to pass you on Naomi's details. Just send us an email and I can introduce you. But yes, if you need more information, she's good to ask. Somebody has just said, and I won't mention your name, the 60% tax bracket, if I'm 5k into it, so this person will be earning 105,000, would it be better to pay into a workplace pension over the next 3 months or a private pension before April? So if your company allows you to do salary sacrifice, paying the money extra into your workplace pension would be preferable, because it would save you national insurance contributions. And I've forgotten, I've fallen asleep over the Christmas holidays. I can't remember, it's 2028, I think it is, when the new rules will change, when salary sacrifice will be capped. But until then, paying in between now and the end of the tax year would be preferable if they do salary sacrifice, because of that national insurance saving you'll also make. It will also mean you don't have to do a tax return. If you do a private pension contribution, you're going to have to do the tax return, but maybe you were doing one anyway. And then the last thing to take into account is a lot of employers are actually quite strict on how you can vary your pension contribution. So we go into a mad panic every March because most clients get their bonuses in March, but the employer, in some cases, the employer pension contribution deadline, employee contribution deadline with their employers is at the very beginning of March. And so we can't pay in time. So it's probably worthwhile as well just checking the rules if they allow you to vary it and are flexible, because some do, some don't. So I hope that was helpful for you. I think, let me see, have I answered everything? I think so. If you want to keep learning more about money throughout this year, there's going to be a topic every month, and we'll send it out in advance. We'll, if you're happy to, the emails that you've used to sign up to here, we'll just send you notice in advance that you can book the slot. And then also later on this month, we're going to be doing a more in-depth dive for an hour on how to retire 10 years earlier. There's no magic solution, but it's just me talking you through the different things and sort of expanding a bit more on this, the difference between what somebody needs to do to be able to retire that little bit earlier and the tweaks they can make. But the other side of it is I've got a psychologist supporting me on the session, and called Sarah, and we've done some sessions before in the past that were very well received, because the problem that I have as a financial advisor, believe it or not, is we plan clients' retirements to the number, and the clients are able to retire at the date that they choose, but when it actually comes around, they're not psychologically ready, and the majority of our clients retire and then actually end up going back to work, and I kind of see that as a failure. So we're starting to prepare our clients psychologically for retirement. And so Sarah will be also giving some hints and tips about what does early retirement mean, because in this example, if you're retiring at age 55 and all your friends are still working because they only started thinking about their retirement planning at age 55, you need to have a support network around you to make sure you're actually having lots of fun. So that's me. All the details will come in a follow-up email shortly. So thank you so much for everyone coming, and well done for making January count.